All right, so well, thank you for the invitation to be here. Today, I am presenting a paper that is still a work in progress with some colleagues at the Central Bank of Colombia. Its title, as Steve just said, is, I'll just say the short part, the banking limits on foreign holdings. Now, I understand that Catherine's going to give her comments in Spanish, so that's going to be quite a treat for everyone. Might be just making that up, sorry. All right, so the objective of the paper is to analyze the effects of banking constraints on the exchange rate. And we're going to be looking at the inner workings of the portfolio balance channel. So in other words, we're going to be looking at the banking preferences on the mix of different currency-denominated assets. Our paper is an empirical paper, yet we construct a two-period model where constraints inhibit capital flows. But this is just mostly as an illustrational exercise. And what we find is that it is only when the uncovered interest rate parity fails that we can explain the effects of sterilized foreign exchange interventions. We then empirically test this channel by using a sharp policy discontinuity in banking limits, and also by using a proprietary data set that contains daily balances of every financial institution in the country. And as a flash forward, what we find is that the effects on the exchange rate are short-lived and magnified in periods of central bank intervention. Now, the empirical evidence has shown that the corner hypothesis that postulates that countries are moving away from intermediate regimes towards either hard pegs or fully flexible rates began to lose popularity after the East Asia crisis in the 90s and the failure of Argentina's currency board in the 2000s. Since then, there's been many central banks that have opted for monetary policy autonomy, but they've been, or a lot have been reluctant to relinquish control over the value of their currencies. In fact, industrialized countries have led concerted initiatives, such as the Smithsonian Agreement, the Plaza and Louvre Accords, the Chiang Mai Initiative, and the Pittsburgh Agreement. Emerging markets have also frequently intervened in the foreign exchange market, but in less coordinated fashion. Now, the impossible trinity or trilemma indicates that a country cannot simultaneously allow for free capital flows, have autonomous monetary policy, and have a fixed or managed exchange rate due to arbitrage by foreign investors. That's Sebneb was commenting on this before. But what we see again is a bunch of countries trying to target all of the three. So it does raise the question of whether central banks sometimes overreach, especially when the effects of policy are limited. And in the empirical literature, there's been a lack of consensus regarding the effects of foreign exchange intervention in particular, not so much for the interest rate intervention. Recent surveys show that half of studies find significant effects, while half don't, and those that do find short-lived effects on the exchange rate. And there are even fewer studies that directly address the portfolio balance channel. Here, Catherine and Jeffrey Frankel have made significant contributions over the past decades. So again, what we try to do in this paper is to see if the impossible trilemma breaks by imposing some sort of capital controls that are going to take the form of financial rigidities. We think the Colombian case is interesting because since 2004, the central bank imposed limits on the amount of foreign assets that commercial banks could take on. And our conjecture is that when these limits are binding, then banks are not indifferent between holding assets denominated in pesos or in dollars. So let me just say a few words on the model. We consider a two-period small open economy with a representative household that faces limits on the amount of foreign assets, so very similar to the Colombian banks. and a representative government that's going to take the role of a central bank. The government is going to issue debt, domestic debt, to buy foreign assets. This is going to be your typical sterilized foreign exchange intervention. And what we find is two equilibria, one in which constraints do not bind and the uncovered parity holds, and one in which the constraints do bind and the uncovered parity does not hold. In this second case, households are going to want to save in the asset with the highest return until limits bind eventually. And the exchange rate is going to depend on both the regulatory limits as well as foreign exchange intervention. So this is a sketch of our model. Again, we make several oversimplifying assumptions throughout. In the first period, the household can save in domestic assets, denoted by capital B, or foreign assets, but expressed in domestic currency. That's why it's multiplied by the exchange rate, that in our case is defined as pesos over dollar, domestic currency over foreign currency. The household is also going to get an exogenous endowment and a lump sum transfer from the government. In the second period, the household is just going to receive the payoff from having invested in both types of assets. And finally, the household is going to be financially constrained on the amount of foreign holdings relative to its income by both an upper and lower bound. Again, this resembles very closely how banks in Colombia are regulated. The government in period 0 is going to issue domestic debt and is going to buy foreign assets. In the second period, the government is going to pay off its debt and is going to receive dividends from its foreign investments. So from the households problem, we obtain this neat expression where domestic assets equal expected foreign assets. That's the uncovered interest rate parity condition right there, plus or minus an additional term that is going to show up when financial constraints bind. Let me just skip over some formalities. I think that our model can be summed up in this slide. So basically, when constraints do not bind, then the exchange rate will not depend on foreign exchange interventions. Foreign exchange interventions are futile. When constraints do bind, then there's going to be a wedge that is going to depend on both regulatory limits as well as the amount of foreign assets that the government makes. If you take, for instance, a typical case, for example, Colombia, that purchases a lot of foreign assets, then this last term is going to become smaller, the whole wedge is going to become less negative, and the exchange rate is going to go up, meaning that domestic currency is going to depreciate. Let's move towards the empirical methodology. So what we do here is to conduct a sharp regression discontinuity design to study the effects of banking limits. So essentially what we do is to compare episodes in the immediate neighborhood of financial constraints. The limit imposed on foreign holdings creates a natural experiment when in close proximity of the cutoff point. So episodes in which financial institutions barely faced the financial constraint are going to be the treatment group, and episodes in which financial constraints barely missed the threshold are going to be the control group, and hopefully ideal counterfactuals for financially constrained institutions had the constraints not been binding. What we do is to analyze causal effects in regimes with and without central bank intervention.
So what would cause the different central banks? We're talking about some expected change rate movements. I mean, why some?
Yeah, that's correct. So foreign holdings are going to have the exchange rate inside. It's going to be a relative term of net foreign assets over total equity. I'm going to get to that in a minute, but all expressed in domestic terms.
You can ensure in the way that the change. Yeah.
Since we're on a little bit of time.
Yeah, but that's important for.
All right, go ahead, Ben.
Yeah. Although I think that might be clear in the next few slides. If not, you can ask Sunitanda. You get a couple of more minutes.
I thought you were the way.
I'm sorry.
All right, so, well, for those of you that are not entirely familiar with the regression discontinuity designs, they do root back to an influential paper in the 60s by Thistlethwaite and Campbell. The methodology lay dormant for almost 40 years until its resurgence in the year 2000. But we still see limited applications to macroeconomic questions. And I think that is partially due to the intrinsic difficulty of finding a deterministic rule that triggers policy. So in our case, dt is going to be our policy variable, and it's going to be an indicator function that depends on a running variable or an assignment variable xt, which in our case is going to be the amount of foreign holdings. And it's going to turn on whenever it surpasses a given threshold x0. And you can show that you can estimate the average treatment effect on the treated by comparing the conditional mean of an outcome variable when the assignment variable barely faces or barely passes the threshold compared to when it barely misses the threshold. In all RDD studies, the conditional independence assumption is met, but one does, however, need to assume a continuity assumption on the conditional distribution of potential outcomes at the cutoff point. You can argue that this assumption is met if there is no manipulation on the running variable. So a heuristic way to test for this is to examine the distribution of the number of observations of the running variable. So I'm showing here the densities for the entire financial system as well as the 5 largest banks in the country. I cannot disclose their names, so I'll get into trouble. And we don't reject the null hypotheses so basically there is no discontinuity at the cutoff of the running variable, meaning that, or suggesting that there's no direct manipulation. Specifically, what we do is to estimate a vector theta of impulse response coefficients that measures the effects of financial constraints on an outcome variable, such as the exchange rate or portfolio balances. In a paper with Guido Kirsteiner at the University of Maryland and David Phillips at Notre Dame, we try to extend part of this framework to a time series setting, and we use some of those extensions here as well. And note that when the bandwidth choice H is large enough to consider the whole sample size, then and you impose a rectangular kernel, then you're in a world of global parametric regressions where the estimates are affected by data far from the discontinuity point. There are obviously some caveats of using this methodology. As horizon expands, then the control days get contaminated with the treatment days. There are some assumptions that cannot be fully tested, but they do have some testable implications. And results can also depend on the kernel used and the bandwidth choice. For this paper, we've followed the methodology proposed in Imbens and Kalyanaraman. But in ongoing work, we are trying to replicate some of the methodology proposed in Calonico, Cataneo, and Titiunic. So let me just show you the data really quickly. This is the entire financial system's foreign exposure as percent of, in terms of total equity. And what you can see here is that the upper limit was never reached, was never binding, while the lower limit was occasionally binding. We use an effective lower bound of 1%, which is not when the fine or the penalty was imposed, but rather when the minimum buffer of foreign exposure was breached. So this basically happened when alarms. So when institutions reach this lower bound, alarms go off in every financial institution, as documented by the central bank. This graph shows the official foreign exchange intervention in Colombia. So in some countries, you can't even show this graph due to the high level of confidentiality of the data. In any case, don't tell Echavarria, Steve, about this, our newly appointed governor. But there are a few studies to be drawn from this graph, at least two. One is that there's a bunch of different colors. So lines going up means that the central bank purchased foreign currency or foreign assets. Lines going down are sales of US dollars. So the different colors represent the different mechanisms through which the central bank intervened in Colombia. The other story is that if you ignore the blue, then a lot of lines are going up, but very few are going down. And this asymmetry in the literature has been coined, and we've mentioned this in the conference before, as a fear of floating, or a fear of appreciation, at least by economists such as Calvo and Reinhardt, or Levy and Yayati. All right, so let's move on to the results. These are the IRFs of exchange rate changes due to financial constraints, especially when they were binding. So again, what we see is that, and we consider that for the whole sample for episodes of foreign exchange intervention and episodes of non-foreign exchange intervention. And what we see is that financial constraints had a significant effect on the exchange rate, but short-lived for almost about 2 weeks. And it seems as if they can be explained by episodes of foreign exchange intervention. So we've also considered outcome variables, one per financial institution, and also gathering the 5 largest banks in the country. We, for the moment, have tried portfolio measures such as foreign assets minus liability as a share of domestic assets. That's a daily variable. We've also tried different loans in US dollars over loans in pesos. The problem here is that jumps in this variable can be attributed to either the jumps in the exchange rate, as we saw in the previous slide, or jumps in portfolio balances. So additional work that is not yet reported shows that it's due to both. So let me just conclude here by saying that so one of the things that we are trying to extend is the 2-period model to a n-period model. We think that we can have something to say about the role of the current account and on the dynamics of this channel. And in the empirical application, we are trying new variables and a bunch of robustness checks as well. New variables include daily capital in and outflows, as well as exchange rate forwards and other derivatives.